Okay, let's start out from one of the most important current asset, which is cash, right, and marketable security. Cash means the currency and demand deposit. And cash management means you need to know what should be the appropriate level of the cash. When you look at your balance sheet, you need to know how much should it be, right? How much should be the appropriate level or optimal level. And the objective of cash management is to know the optimal and compare with the actual level of cash. And then you need to know how to invest excess cash. Excess cash means when you have the optimal, which is lower than the actual cash, right? And also you need to know how to deal with the cash deficit. Means what? The optimal level of cash is higher than the actual cash level. Why do we need cash? Of course, right, to use for day-to-day operation. In case of emergency and speculation, let's say you speculate the material price to increase. Next week, you might use cash to buy the material now instead of next week. Let's say if you have excess cash, what can you do with your excess cash? Number one, you might look at your project. You might have your new project, which is, the rate of return is greater than the cost. So you might need to use the cash to finance new project. Or you can also use excess cash to invest in marketable security. What is marketable security? It's any equity or debt instrument that is readily sellable, just like blue chip stock, blue chip stock, high quality, big company stocks, government bond, short-term commercial paper, maybe certificate of deposit. So if you have too little cash, what should be the problems? You might not have enough cash to do 3 activities, right? Or you might get default. However, if you have excessive cash or too much cash, it's not good for the business. Why? You lose opportunity to invest something. Since the cash provides you very low rate of return, okay? So you better use cash to invest something rather than keep it. So there are 2 fundamental problems of cash management. Number one, you need to keep enough cash on hand to meet the firm cash disbursal requirements on a timely basis. And number 2, managing the composition of the firm marketable security portfolio. So the first one, right, maintain the sufficient balance. How do you maintain the sufficient balance? Of course, right, you need to forecast, to be able to forecast the use and the source of cash in the future. AKA means you have to do cash budget. Cash budget, unlike cash flow statement, because this one is future. We predict those cash outflow and inflow. Unlike cash flow statement, it's all past, right? So as you can see here, this is quarter cash budget. We start with beginning cash balance plus customer receipt, so that you get available cash less what cash disbursement, like you pay cash for direct material, direct labor, selling admin, pay tax, for example, and then you get total cash disbursement, right? And then you make difference between available cash with the cash disbursement, so you get cash balance at the end, right? So you might have cash deficit or cash surplus, right? If you, in case of cash deficit, you need to know you need to plan how to finance the deficit. And you might have the question, how much should be for the target cash balance, or the optimal level of cash balance? So we can use what we call Bermo model to find optimal cash balance, right? C is optimal amount of cash, right? F is cost of providing cash, like from transaction. Maybe when you try to convert marketable security to be cash, you have to pay fee, you have to pay commission, or maybe you go to borrow money from the bank, you might need to pay fee, right, to the bank. F means cost of providing that. T means demand of cash for a given period, right? How much do you need for a given period? And K is your interest rate, or your rate of return for this. So you put all the number into C, right, or Baumol model. For example, manager of AA Corporation forecast the need of cash for the next month is 900,000. The cost of converting marketable security to be cash is $500 in average. The rate of return is 12% per year. Please calculate optimal level of cash. You use Baumol model, right? 2 multiplied by F is 500. T 900,000 divided by rate of return. Since this question give you monthly demand, right, for cash 900,000, so interest rate need to be per month instead of per year. So 12% per year equals to 1% per month, and power by 0.5, so you get optimal level of cash equals to 300,000. So optimal is 300,000. If you have cash more than 300,000, it means you have excess cash, right? What you can do with excess cash, as I said before, you can invest in a project, or you might use it to buy marketable security. Not only optimal level that you have to maintain, you need to add with minimum amount of cash, because you're not going to let your business have zero cash balance. So the component of minimum amount of cash is number one, compensating balance, right? It's our deposit held by the bank to compensate it for providing service. Plus emergency case, right? How much do you spend? Plus transaction balance, right? Money need to cover check outstanding. So as you can see in this picture, right? You see the top of the picture is optimal level of cash. Let's say from the example is 300,000. And then when the time goes, you use cash, and cash will be reduced until point R, right? You see point R. R means reorder point. Reorder point means the moment that you need to do whatever to increase cash, to order new cash to the firm, right? And L is lead time. Lead time means the moment that you start to go to raise new cash, right? Until the moment that you get cash, actual cash to the firm, and then you will get another 200,000 into optimal level again, and then you start to use it until the order again, and it will be fill in 300,000 again and again, right? But of course, you're not gonna let your business to have zero cash balance. That's why we have to add with, you see, under the horizontal line, right? You have plus minimal level of cash. You have to add with minimum level of cash, right? Because you're not gonna let your business have zero cash balance. How do you calculate minimal level of cash? 3 components right here, okay? Problem 2, managing the composition of the firm's marketable security. So how do you buy marketable security, and how much should it be? Of course, right? You compare the optimal level of cash with the actual level of cash, and if the optimal is lower than actual level of cash, optimal plus minimum level of cash is lower than actual cash balance, you might have what? To use cash, right, which is excessive cash, to buy marketable security. And those are the example of marketable security, right? You have instruments like treasury bills, federal agency security, banker acceptance, negotiated certificate of deposit, blah blah blah, and then you see denominations, right? 1,000 and increments of 1,000 for treasury bills. You have maturity, you have the basis, right? You buy by discount basis. Liquidity, right? You can also see the characteristic in terms of liquidity, and also taxability, right? For example, treasury bills exempt from state and local income tax. Okay.